They think you are stupid. They think you are weak. They think that if they paint a red candle on a chart, you will panic. They think that if they drop the price of silver by 25% in 6 hours, you will hand over your wealth to them for pennies on the dollar. On Friday, January 30th, 2026, we witnessed one of the most blatant, arrogant, and criminal market manipulations in the history of finance, the Friday Massacre. Silver was trading at all-time highs. The momentum was perfect. The fundamentals were screaming shortage. And then at exactly 8:30 a.m., the moment the New York session opened, the floor disappeared. Billions of dollars in notional silver contracts were dumped onto the COMEX in milliseconds. The price collapsed. It fell from $120 down to $90 before you could even blink. The mainstream financial media, the mouthpieces for the banks, immediately started reading from the script. They said it was profit-taking. They said it was a natural correction. They said the RSI was overbought. Rubbish, all of it. You do not get a 25% crash in a physical commodity during a supply shortage because of profit-taking. You get it because someone made it happen. You get it because the biggest players in the room, the bullion banks, the market makers, the entities that are currently short billions of ounces of silver, decided to pull the plug. But why? Why crash the price if demand is so high? This is what we are going to break down today. We are going to expose the real plan, because this crash wasn't the end of the silver bull market. It was the trap. It was designed to shake you out. It was designed to transfer the physical metal from your hands into their vaults before the real repricing begins. To understand the crash, you have to understand the difference between price and value. The price of silver is determined on the COMEX futures market. It is a casino where bankers trade paper contracts that claim to represent silver. For every 1 ounce of real silver in the vault, there are upwards of 300 to 500 paper ounces traded. It is a game of musical chairs. The value of silver is determined by physics. It is determined by industry. It is determined by the fact that you cannot build a solar panel, an electric vehicle, a Tomahawk missile, or an AI semiconductor chip without it. On Friday, the banks crashed the price. But did they change the value? Did the solar farm stop needing silver paste? No. Did the Pentagon stop needing silver for guidance systems? No. Did the mines suddenly discover a massive new vein of silver that doubled the global supply overnight? No. The physical reality remained exactly the same. The supply is still dangerously low. The deficit is still nearly 300 million ounces a year. So if the fundamentals didn't change, why did the price crash? Because the banks were trapped. You have to look at the open interest. Going into last week, the bullion banks, led by the usual suspects, JP Morgan, Citi, HSBC, were holding a massive short position. This means they had bet that the price would go down. They had sold contracts they didn't own. As the price rocketed past $100 and headed toward $120, these banks were facing a mathematical catastrophe. They were getting margin called. They were losing billions of dollars every single hour the price stayed up. If the price had gone to $150, some of these banks would have gone insolvent. We are talking about a systemic failure. So they had two choices. Choice A, admit defeat, buy back their shorts, and send the price to $500 and bankrupt themselves in the process. Choice B, cheat, rig the game, use their massive algorithmic power to flood the market with paper sell orders, trigger a panic, and force the longs, that's you, the retail investor, to sell. They chose choice B. They always choose choice B. They executed a stop-loss rate. They know exactly where your stop losses are. If you bought at $100, you probably set a stop loss at $95. If you bought at $95, you set it at $90. The banks push the price down just enough to hit those triggers. Once your stop loss is hit, your broker automatically sells your position. This creates a wave of selling. The price drops further. It hits the next level of stops. More selling. It is a self-fulfilling avalanche. The banks just started the snowball. The retail panic did the rest. And here is the evil genius of the plan. Who do you think was buying when you were selling? Who bought the silver at $90 when you were panic selling it? The banks. They crashed the price to cover their own shorts. They sold high paper and bought low, your real contracts. They unwound their dangerous positions using your fear as the liquidity. This is the wash and rinse cycle. They have been doing it for 50 years, but this time the stakes are different. This time they aren't just trying to make a quick profit, they are trying to survive. because they know what is coming next. They know about the industrial cliff. We talked about Greenland in the last video. We talked about the rare earths. Well, silver is the cousin of the rare earths. It is the most conductive metal on the periodic table. The AI revolution is an energy revolution. It requires massive amounts of electricity. That electricity needs to be transmitted. That means silver. The Green New Deal, whether Trump supports it or not, is happening globally. China is building solar farms the size of cities. Each panel uses silver. The demand is exponential. The supply is flat. Mining production has been stagnant for a decade. You can't just flip a switch and get more silver. It takes 10 years to build a mine. The banks know that a physical squeeze is inevitable. A physical squeeze is when an industrial buyer, say Tesla or Apple, shows up at the COMEX and says, I don't want cash settlement. I want the metal. Deliver it to my factory. When that happens and the COMEX says, we don't have it, the game ends. The paper price becomes zero and the physical price goes to infinity, unobtainium. The crash on Friday was the banks trying to delay that moment. They are trying to shake out the speculators so they can hoard the physical metal for themselves. They want to be the ones holding the bag when the repricing happens. But the bag of metal, not the bag of shorts. So what is the real plan? The plan is a wealth transfer. They want you to get discouraged. They want you to look at your account, see the red, and say, oh, well, silver is a scam. I'm selling. I'm going back to the S&P 500. They want you to capitulate because every ounce you sell is an ounce they pick up for cheap. Look at the premiums. This is the smoking gun. If the crash was real, if nobody wanted silver, the premiums on physical coins and bars would have crashed too. Did they? No. Go to a bullion dealer site right now. Try to buy a silver eagle. Try to buy a 100 Oz bar. The premiums are sky high. In some places, they are 50% over spot. This means the real market, the market for actual stuff, ignored the crash. The dealers know the paper price is fake. The buyers know the paper price is fake. While the screen says $90, the street says $130. This divergence is the signal that the manipulation is breaking. The rubber band can only stretch so far before it snaps. We are also seeing the geopolitical angle. Russia and China are buying. They aren't buying contracts. They are buying physical. The BRICS nations are rolling out their new payment system. It is rumored to be backed by a basket of commodities. Gold and silver are the anchors. Do you think Putin cares that JP Morgan smashed the paper price on a Friday morning in New York? No. He laughs. He takes the discount. He buys more. The East is draining the West of its gold and silver. The West is playing paper games while the East is playing physical chess. And let's not forget the Trump factor. Trump hates a strong dollar when it hurts manufacturing, but he loves a stable system. He knows the COMEX is a fraud. There are rumors, unconfirmed but persistent, that his administration is looking into market integrity regarding the metals. If the DOJ investigates the spoofing that happened on Friday, if they subpoena the trading algorithms of the big banks, that is the nuclear event for the shorts. Remember, JP Morgan has paid nearly $1 billion in fines for spoofing metals before. They are convicted felons in this regard. Do you think they stopped? No. They just got better at hiding it. But Trump's DOJ might not be as forgiving as the previous administration. So where do we go from here? First, you have to master your psychology. Investing in silver is not like investing in a stock. It is psychological warfare. You are fighting against the most powerful financial institutions in the world. They have unlimited money. They have the regulators in their pockets. They have the media. The only thing they don't have is the metal. That is your leverage. If you own physical silver, you are winning. The price on the screen is a psychological operation, SWI-op. It is designed to make you feel pain. Ignore it. Ask yourself, do I have the same number of ounces today as I did on Thursday? Yes. Has the world discovered a replacement for silver in electronics? No. Is the U.S. debt still spiraling out of control? Yes. The crash is a gift. This is the dip everyone says they want. When silver was at $120, people were saying, I wish I bought at $90. Well, now it's at $90. And what are people doing? They are scared. That is human nature. That is why the poor stay poor and the rich get richer. The rich buy the panic. The poor sell the panic. The real plan is to flush you out so they can ride the rocket up alone. Don't let them. This is an accumulation phase. The chart looks ugly? Good. Ugly charts are where fortunes are made. Beautiful charts are where bag holders are made. The Friday massacre was desperate. It was sloppy. It was too obvious. When a manipulator gets sloppy, it means they are scared. They are losing control of the narrative. They can print paper silver, but they can't print physical silver. And the vaults are draining. The COMEX registered category, the silver available for delivery, is at historic lows. One major industrial order, one tech giant deciding to secure their supply chain, and the paper market implodes. Hold the line. Do not let them steal your position. This was a raid, but the raid failed to break the physical market, and that means the explosion is still coming. I will be tracking the Commitment of Traders report to see exactly what the banks did on Friday. I will be tracking the vault withdrawals. I will tell you the truth that CNBC won't. The game is rigged, but if you know how it's rigged, you can win. They crashed it on purpose. Now you know why. Subscribe to the channel. We don't sell, we stack. I'll see you in the next video.